This entity holding LLC will hold, like, think of all the big equipment. This holding company is just owned by the same Rev Trust, right? That's all we're doing, is we're separating liability here, and we're playing with depreciation because we're going to have a lot of depreciation at this holding company. So sometimes what we do with these clients is that they'll have tons of depreciation. In other words, they'll have tons of losses here at this holding company. So what they'll do is they'll try to pay this company as much as possible to offset all of the depreciation, right? So if you have $100,000 here of depreciation, you know, you'll try to attempt to make the lease payment to be somewhere around that amount. Obviously, it has to be a fair market value payment. But the idea here in a tax planning perspective is that you want to offset that with the income from the S Corp, right? No, not necessarily, Jeffrey. You just want to make sure that you're paying yourself enough salary. He was actually a dental practice owner. He sold his practice to a DSO. I'm sure you know what a DSO is. And he was 72 years old, Ryan, and he had a safe harbor with a cash balance as well. Ryan, I think the only thing you have to ask yourself as a dentist is, like, how much longer do you want to keep working, right? And the client that I had, he was in his early 70s and he was still working because he liked it. I think that's fine. It's totally fine. So many. So I know the whole DSO process. I know the 60-40 split. I know the cash balance. I know the QBI deduction limitation. Like, I know doctors probably better than anyone else.